What are those sneaky traders and investors up to on Wall Street? Nvidia might have hit an all-time high, but dark pool liquidity is starting to show its ugly head once again in the Russell 2000, Dow Jones, and home builders. We know that if all these fall together, it could be the pullback that some people have been looking for. But in today's video, we might need to discuss even a more important topic. What exactly is going on with the 10-year yield? It's absolutely skyrocketing, and we need to discuss. Stocks, commodities, and cryptos, let's get into them in today's video. This one's not to be missed. We'll see you in a moment. Well, welcome back everybody to The Daily Show. My name's Tom, and in today's video, we'll be discussing together the latest macro, lead indicators, and of course, the hottest charts happening right now. It was a day led by Nvidia, but really it's probably what's happening underneath the hood with the dark pool liquidity and the big options flow that we need to discuss in today's video. If it's your first time here, remember to subscribe, smash that bell icon, and give the video a like if you enjoy the content. And do remember, we cover everything to do with stocks, commodities, and cryptos every single day here on the channel. Let's go through one of the long-standing concepts of 2024 together. Now, we've believed for a while we're following either the 1960s or the 1990s style run. And this bull market is very, very similar. In fact, the 1960s overlay is one of the best periods that we've used so far. Now, remember in our last video, we discussed the idea of lost decades. We've got another good chart coming up in just a moment for that. But will we see a negative 10% pullback? In terms of stats, we're starting to become due for one. But as we've argued, it's more than likely going to happen in 2025. And if we follow a similar line to the 1960s period, it's more than likely going to happen somewhere around April to May of 2025. Now, this is a very interesting overall overlay, I think. And of course, we know that with Wayne's data actually taken into account, it may be as early as January of 2025 that we see this pullback. So something to keep in mind, something to, of course, keep in the back pocket if we get technical reasons to say the market is actually due for that pullback. But what I want to focus on here is where we are right now and where we were back in 2024, kind of equivalent of the 1960s run, right around a little pullback in the markets. And of course, we have been following some of these to a T when it comes to market pullbacks and the overall analogs. I love this thing. I think it's pretty awesome. Good work, Mark, there for overlaying them for us. Now, in terms of the Sp500 left multiple PEs and the lost decade concept that we spoke about in our video on the weekend, make sure to go and watch that if you haven't already after watching this video. We discussed the idea that we need to be open to the concept of a lost decade or a poor index investing decade over the next 10 years. Now, Goldman Sachs, of course, have come out and said they expect slower and lower returns, and then they've been rebuked by Morgan Stanley almost immediately saying, no, we expect strength. And this is kind of what you want. You want people to have differing opinions, but in general, you want to be looking between the lines and saying, does the data support this? Well, of course, multiples are high. Now, many people have pointed towards these multiples being high as we're overpriced market, we're going to blow up, we're in a bubble. Do you remember multiples can get even higher, such as they did during the tech boom? But in general, there is a decent chance that a lost decade concept could be coming in, and we may see a bit of a compaction of overall valuations if we end up going into a crash. Keep that in mind if it ever happens in the future. Maybe even save that chart. It's a good one to have. But what about if we look at whether the market can go up more? Well, we've shown some stats, and we'll show some again in this video, that are pretty strong towards the bull end. But let's take a look here at Tom McClellan's new work, and we've seen this chart before, which is basically the S&P 500 divided by M2, and you'll notice that yes, we're pushing up, but again, we're not quite at those tech boom style levels. So again, valuations could go up further, as we know, and we expect at the moment Wall Street to love the Goldilocks style situation that we're in. Now, could the election change that? It's probably unlikely. In fact, in a video up and coming soon, which I've done in a few speeches around here in Australia, I can show you that generally speaking, you don't need to be too worried about the election from a market-based perspective. But I do have a stat in today's video of what at least Bank of America is sending out about which candidate wins and what it means. Let's take a look at bull markets and bear markets. On average, a big bear market will give you around 32% pullback. And of course, a bull market will give you some significant gains of 153%. Now, in general, I may disagree with some of these particular dates in terms of where bulls and bear markets have started, because a technical bear market does start after you fall down over 20%, meaning there should be a few more in here. But you can see that there is a strong correlation towards bullishness in markets. Always remember that. In fact, if you went and you bought the market and then came back a month later, in general, you would be up. And that means that the market is rigged slightly towards the bullish side. Now, once you identify that, you know that being bearish on markets is much harder. So you've got to be pretty sure. And more importantly, sometimes it pays to actually let the market fall off and then to buy the dip. This is a strategy that, of course, many successful big hedge fund managers do use, and they actually don't usually go towards the short end. And you've just got to remember that it's all about bringing the data, the reasons, and the sensibilities behind that, which is what we do here on the channel together. So it's great to have you on board. Now let's talk S&P 500 price versus the overall valuations. Again, could we go higher? Well, if we enter back into 2001 territory, the answer is quite simply yes. But do remember, it's not really this metric that matters. It's usually the forward PE and what the market believes is going to happen in the future. And at the moment, the big story, I believe, in the undercurrents is that the financials and the industrials made all-time highs. And when that happens, we tend to see pretty strong 3, 6, 9-month results in particular, even into 12 months. Now, why is this? Well, a lot of it has to do with momentum. A lot of it has to do with basically not so much earnings, but the fact that stocks are loving themselves right now. We've had strong momentum and strong gains on gains on gains. Where I think the problem could be is that we've just had 2 exceptional years, and of course this year's not in the book, but it's probably going to be an exceptional year. Will we get a third exceptional year? Well, the third year does tend to be weaker on the overall gains, and that could point towards 2025 starting maybe even rocky or very, very well, and then at some point turning rocky throughout the year. And that's why it's going to be a great year for traders and investors to be able to find opportunities in markets. Now, we mentioned before the Russell 2000 had some big dark pool trades on it. We'll go through those in just a few moments, but I did want to talk about the fact that it's pretty normal for the Russell in particular to suffer around this period of time. And you'll notice that if you actually took October 22nd or 21st, generally the Russell has a very bad correlation into the beginning of November around this period. So it actually usually finds weakness here and then finds incredible strength leading into December, and especially post the election. So could you be looking at the Russell as a positive way? We'll argue that in just a few moments. Now, maybe a controversial topic, but again, this is just basically the chart data from Bank of America. You can see here that taking just one consideration into it, if a tax hike was to come through, which of course we're seeing from the Harris campaign, we would maybe see around a 5% EPS hit. Now you'll see here what basically is expected on both ends, and this is what Bank of America believes would happen to each one of the stocks. Now, this doesn't consider everything into taking away, but I just saw it around the internet. I thought I would share it with you guys so you can kind of see the impacts of what at least a big bank might be expecting. I tend to believe that most of these things don't actually pass through. So what you'll end up having is the market will really be, are we actually in a trapped economy? That is, that we have a winner, but we've got, let's say, somebody winning the presidency and then the Senate being the opposite. If you do have those types of situations, the markets tend to love it. Why? Because they know how to forward project the earnings. They know how to forward project the economic uncertainties. And it's actually better than a sweep either way. Remember, what you're really worried about if you're a market trader is a sweep either way. And you might say, well, I'm not worried. Well, that's actually the one statistically that is worse. But in all cases, the 3 months after the election tends to be positive. And I think that's a very important factor when you're considering all of these risks that the market's putting on and all of these uncertainties and fears that we're being fed by the media across the board, whether it be on social media or, of course, the general news. Let's talk earnings season, because, of course, earnings season is kicking off and we're seeing the Magnificent Seven being expected to grow at 18% year on year, which is incredible growth driven by AI and driven by, of course, just in general innovation. Now, this is the expectation. We do know that at the moment, the market's loving themselves, but I thought these were some great charts that I wanted to share. First one here, that Goldman Sachs believes that equal weight markets are now going to outperform over the next coming years. Now, this is an interesting one because, of course, equal weight in particular has been performing very poorly versus the main market. So will it start to turn around? Well, already we've seen signs of that in recent weeks. And if we do continue to see strong rate cuts, that could certainly be an interesting point. Another one, though, that I thought was really interesting was Goldman Sachs strategists have now calculated that there's a 72% probability that 10-year treasuries will outperform the S&P 500 over the next decade. Wow. I don't think this is necessarily unfounded. In my opinion, there is a good chance that, of course, treasuries, which we'll be looking at soon, may perform very well. Do I think they perform better than the market? My opinion is probably not, but this is in line with their analysis of course, the S&P only getting 3%, which you can see here is the baseline. Now, if they were correct on that, then of course, yeah, you may see treasuries do well. But I think the point is that there could be a good Goldilocks period for treasuries sometime over the next couple of years. And yes, I know that Druckenmiller doesn't believe that and he's gone negative on it, but who knows? He might be using this as exit liquidity. Who knows on that one? Now, where are we? Well, of course, we're in the 10th decile here. So basically, when we take a look at markets, we know that we're pretty high in terms of the overall valuations, and we saw that from before. Now, you may not know this, but this is actually the biggest earnings week of this current earnings season. Week 3 gives us 33% of all stocks, and while we're not seeing the big tech stocks that are really going to move the market except for Tesla, it is important to note that these next 2 weeks are the most important. Now, you'll also notice there's not much news this week coming out, and that's to allow earnings in general, my belief, to actually play out the way they're going to, and then they stack news on either side so they can say, oh, don't worry, we've got your back. Or, of course, oh, everything's great, don't worry, we're not going to do anything just yet. EPS upgrades are still coming through from the big banks, meaning that they believe that markets will end up being bullish. And, of course, we know that the big all eyes are on Tesla. After earnings market, 6.2% options move expected. This is going to be a huge event, guys, and we need to continuously watch Tesla because it continues to stay in a very tight range. Now, you might be loving gold, and I am also loving gold. But one of the things that people are looking at here from gold correlation is they're basically saying, well, look, gold's been moving up because global money supply has also been increasing. This is definitely one of the arguments. Of course, it's not the only argument towards gold. I have so many reasons why I love gold right now, but I thought it was a cool chart just to chuck on there. And you can see the correlation between global money supply and overall gold valuations when looking at the charts. Now, we did share this chart here or this particular thesis from Mark Newton, which I agree with quite a lot, which basically talks about the fact that we might be in for a smaller pullback here and that in general, things are getting pretty bullish. Of course, everyone now is basically calling 6,000 on the market and super bullish across the board. We are starting to see some, as we mentioned, dark pool liquidity coming through on some of the major markets. So we'll check that in a moment. But I do want to just quickly mention here before we keep going, crypto markets, because of course, crypto markets are very interesting from a price action standpoint. We saw a nice 68.5 kind of slight break high. We've obviously got a pretty good adoption curve here, which has a very nice overall valuation on it. So of course we could jump away from this trend and start to move up. That is absolutely not improbable in this case. And you can see here the Bitcoin adoption also is kind of following the correct track, etc. So I would say that in this case, things are looking pretty good for crypto. We do know that, of course, we're expecting a big move, and we've so far started to see that. We know that flows are hitting incredible highs here back to do with March and when all the hype was around it. So this is a great sign that this could be a real breakout, and we will continue to watch crypto very, very closely. But now we go to dark pool liquidity. And what does dark pool liquidity tell us about markets? Well, basically, treasuries got purchased. We would have to think they were purchased for the first time now in many, many weeks. And we've been warning against treasuries from the aspect of don't get carried away when everyone wants them. But now I noticed that a lot of people are turning negative on treasuries, including the Drak in his most recent video. And this just so happened to happen with a large trade. Now, you might notice on the left-hand side, there were tons of large trades, and then we were ramped up. So this is the first one. It's not the sign of, oh, wow, go buy treasuries, fantastic trade. But certainly it's a big one. It's one of the larger trades we've seen in the last 2 years. Home builders, on the other hand, have seen large trades all at the highs, and since then they've fallen back. Could this be the high of home builders? Well, it may be, but in general, large dark pool liquidity all over the place, and this is one of the better performing sectors, so something to watch. Now we mentioned the S&P. The S&P's just had a large trade on it, a big, huge trade. And we've seen this also on IVV around these highs, this 58.50 level. We keep getting large trades coming through here, and we've seen that for about a week. Now, in terms of the Russell 2000, we also got a huge dark pool trade coming through right as we go through and make almost a new high. Now, is that coincidence? Well, it's also coupled with another large trade here from the Dow Jones, another big one after, of course, the accumulation, the breakout. Now, could these all be coincidences across the board? They certainly could be, but I will pay attention to them on the price action because as we mentioned in our live stream for the Monday Open, which we do every week, so make sure to come and join us for that, that we were talking about the idea of maybe confusion here. We all know the trend is up. We all know that in general, the next couple of months are expected to be bullish, but would you really want to enter here for the Sp500 or the Nasdaq? Or even the Russell, even though I think the Russell is the better looking market in terms of TA. Well, that comes back down to what's your risk tolerance and what are you looking for. I think as day traders and scalpers, it may be that you want to have a little bit more information. And with those dark pool trades, you've definitely got to consider the possibility here of a small pullback to some of the key ranges. Now, speaking of large transactions, another one that's come through is Tesla. Tesla has a large trade, and of course, that was after the 10-10 event. Ultimately, this one's going to come to earnings season, but it looks like Tesla is more than happy to coil and set for a potential island reversal before the big event. It's going to be a pretty wild event, you would think, because the market is absolutely coiling within a tight range. And whenever that happens, big moves are on the horizon. Let's move over now to the best and worst performers. As you can see, home builders got destroyed after these large trades came through, and that is definitely Wall Street having a go. And at the same time, we saw regional banks dropping, which is definitely a concern considering they broke out last week. What I think is happening here is we broke out and now we've got to trap liquidity. So effectively, we might see further selling in those, trap out a bunch of those buys, get rid of them, create liquidity for, of course, the bigger funds, and then ultimately move higher. Gold has been doing very well since we saw that huge break, dark pool style and gold breakout. GDX performing 7.62%. Excellent trading, guys. Very well done. And of course, we've seen a bit of a pullback here in the metals market as well, driven by, I guess you would say, just like speculation that China's going to come through. Now, do we expect a pullback here? Well, a lot of you guys were asking that question. And I guess if I had to answer, I would say, yeah, the next 2 to 3 weeks are more uncertain than, let's say, the next 2 to 3 months. You ask me the next 2 to 3 months, I'm going to say up. And I'm also going to say that I wouldn't be too concerned if I was in the markets right now bullish, because even if we do get pullbacks, our case scenarios are really got to be this. The weekly 20 being kind of the worst case right now, and of course the 5,700 being the kind of more probable case. Now, in both of those, are they that scary? I don't think they're that scary at all, and in fact, they could be awesome opportunities. So I've done some analysis, and these seem to be the two main levels that seem the most probable, but we cannot discount the fact that we're now 1 and a bit weeks into, of course, what we've seen before over the last year on the channel, which has been a point of either a pullback in time, which is a very small pullback here, or a larger correction path. Now, whenever we've got these types of methods and concepts and overbought kind of signals, what we usually have seen is this type of thing, or as I said, that type of thing. And it's very unlikely that it won't at least see some consolidation. It's just unlikely. It's not impossible, but that's something to be considered. When we look at the futures market, this is the update for the options levels for the next 24 hours. And you can see here that I'm correlating quite a lot with between 5780 and 5800. So I like that level for the first initial attack from the bulls. And I think a lot of day traders are going to be waiting for this zone to be hit and then see reaction around here. I just think it's better to have the patience. I don't know, maybe you want to get involved. I don't personally. I think that if you're hodling, it's all good. But if you are looking for day trades, you really want to find high quality levels. And I think this is a decent level. And I think that also down here is a decent level. So these are the two main factors. Does that make sense, though, to the options market? Because, of course, what people are really arguing here is that, we saw a sell-off, but it recovered strongly into the end of the day. Well, I would just say in general, this kind of looks like sideways chop. So let's have a look at the options market. Does that make sense? Well, it kind of does. Have a look at this options market. We mentioned this in the last video that the market will not want to hold above 58.50 by too much. And of course, it closed at 58.54. Why? Well, because we had that 58.60 kind of call wall. We now have a 58 kind of 50 put call wall fight, as you can see here over the next 24 hours. And 5800 just so happens to be the first major kind of put wall that we've got in the markets. That's the major put wall. The major call wall is now appearing at about 58.75. So if the market's chopping between this zone, it's probably quite profitable for Wall Street riders. We see 5800 prominent again the next day on the 23rd. And of course, if we do see markets continue to go up, what are they going to strike for? 5900 is going to become the call wall take profit level. It's very unlikely to push through 5900 easily because as we can see here, this is just such a huge strike throughout the next 2 days. Then things get a little bit more interesting though when you push out to the end of October. What you'll notice is all of a sudden the big calls come down a little bit. 58.25 becomes the most struck level, and we start to see 5700 being the most struck put. So the clear cases are that the TA is starting to analyze pretty well with the overall put strikes and call strikes. We know that if the markets manage to break through 57.80, there's a good chance we go all the way to 5700, and that's probably going to be where the wall starts to really push through. And what we would expect is if that market comes down into those levels, that this strike will become really well struck. And we'll see that, and I would definitely be looking at it, and of course we'll be tracking it together. So for now, market's kind of trapped within these ranges. Not really super positive gamma or negative gamma at this stage. No real breaks either way. Now, if we go to NVIDIA, it's clearly in positive gamma territory, continuing to push strongly. 143.7, that's a strong close. Obviously, it's in the call wall plus at this stage. So 142 is the call wall, and it's pointing towards the possibility of pushing as high as 150 this week. And you'll notice 150 also becomes prevalent into November. So there's a lot going on here, but this stock is completely bucking the trend. And again, does this point to strong gains in the market over the next couple of months? Well, yes, because whenever NVIDIA is led, which has always been early, the rest of the market has tended to come with it later on. So NVIDIA leads because it's the bubble leader at this stage, and then the rest come with it. Tesla, on the other hand, well, you can clearly see here that there are a lot of strikes, but realistically, heaps of people at 210 and 200, and heaps of people at 230. This is going to be a coil with a big breakout either way, and it's all going to come down to earnings. I don't think we're going to see a pre-earnings pop, or because it probably would have already gone by now. Let's jump on over to the lead indicators here. First up, bonds. Are we seeing concern in the bonds market and therefore we're worried on the stock market? Well, I would say no. Based on this, we're actually pushing down, and this is really telling us that we're not seeing that type of effect on markets. We are, however, seeing some weakness after nice strength, but I will say that I think these are still real breakouts here on regional banks. And I think what they're going to do is something like this, push down to maybe 55 and then maybe find buyers, trapping other people, maybe even pushing this lower low, because there are quite a lot of people, I'm sure, that are super bullish on the Russell, super bullish on regional banks, because they're pretty clean charts and they're very clear. And I think a lot of people have been talking about it. I do think that they look nice. What do you guys think though? Are they traps? Are they something a little bit more sinister? Of course, financials, XLF also just completed the ascending triangle. So that's another one that's doing quite well, but has started to follow down. Now, if we look at home builders, you can see here, that's construction. And if we look here at home builders code, you'll notice that it looks like a Wyckoff pattern. Now, that does actually look like a Wyckoff. We've got the UTAD component over here, which basically is a false break to the high, and it doesn't look too good on these charts. Although the trend is still overall up, it's certainly a little bit more of a cause for concern than normal, and of course, we'll continue to watch it. In fact, what I will do is set an alert underneath here, and that's what I would generally suggest you do, and that will really say if this happens and the market's still doing a sideways, it's pointing more towards, hey, maybe we are about to see that 5,700 being reached by the S&P. Certainly a bit of an early indicator there. Treasuries, on the other hand, fell down a little bit lower. Remember, between 92 and 93 is pretty good buying for treasuries. First big dark pool trade. That's a good sign. Is it a turn? No. Would day traders like it? No. Would swing traders like it? Probably not. Would position-based traders and investors like it? I could see a case for that. So, there's the different strategies for different, of course, levels. So a lot of people concerned about yields right now, but I don't think they're too much of a concern. Yes, we have a trend that is now bullish towards the 10-year, and it's starting to move back up into the 4.2% bracket. But this is probably where you would always expect it to. It's breached the downward trend line, it started to move up, and this is the logical step where it will potentially turn. Remember, this will be correlated fairly well with the US dollar, which we'll look at in just a moment. And at the moment, the US dollar is very close to a key resistance level as well. Now, with the dollar, we've been proven correct so far. We're kind of still expecting the dollar to go to 104. It's continued to strengthen up. And I think a lot of people were trying to short it over the last couple of days. Yeah, I wouldn't have been doing that. Don't fight that trend for now. Let's see how it interacts with 104. Speaking of trend changes though, copper. Now, this is actually a pretty strong level for copper. And you might be looking at it and saying, oh, that looks terrible. Well, it's broken the trend line towards the upside, which is of course a strongish sign. It didn't hold really above here, which is the bad candle. But of course, if this ends up snapping this high in the future, then you'll be knowing the squeeze is back. That'll pretty much tell us China's trade is back as well. So at the moment, this is a point where we have to see copper buyers buy up. Of course, stops underneath here may be safe. Stops underneath here should be safe. And we'll find out whether copper actually starts to fly. This will be really the teller as well for iron ore and for some of the other metals out there. Gold, of course, doesn't care. It's continued to strengthen up. Our favorite metal of 2024 continues to do very nicely here with a great breakout. And I guess we've got to go with, it's going to potentially push towards 2,800. I mean, what else is going to stop it for now? We'll use some fib extensions on it in the next video. Silver's getting close, 34.60, 34.50 would be the aim. It got to 34.20, not quite where I would expect it to go during this initial thrust run. Oil, on the other hand, still looking great on the smaller timeframes. Obviously need to see it break through 71.40 and UK oil to break through, I think it's 75 a barrel. I like Brent a little bit more here on the charts, but some decent action, very similar in some ways to what copper's been doing just on a higher time frame. And we would just like to see it further strengthen. Remember, patience, react, don't predict. This is okay if you're a position-based or a swing-based buyer, but if you're a trader, you wouldn't want to be activated on this just yet. There's no reason to be long just yet. Similar to Tesla, oh wow, 1, 2, 3, 4, 5, 6, 7 days of coil. Woo! I don't know if it's going to be a fizzer, but it doesn't look like it will be. That is a lot of coiling action. Can I even find one like that for a while? It's been a while since I've seen a coil like this one, and especially on a major stock. So it looks like there's going to be some explosive moves based on Tesla's earnings, and the market is getting ready for that event. That is going to be a wild one. Nvidia, all-time high, certainly not a bad sign for the markets. And I've got to say well done to everyone in August and September. If you were watching some of our live streams, watching the videos, then you'd be pretty damn happy. We've been very bullish on Nvidia. We continue to be very bullish on Nvidia into 25. And I think the telling sign, remember, is who had $100 trillion of CEOs sitting in the audience earlier this year? Well, it was Nvidia. And that's why you can't go against them for now. But ultimately, are they overpriced? Probably, but that doesn't really matter in the market. So remember, at the moment, it's not your opinion that matters. It's the concept of, have we run hard enough to really cause a large crash? And Nvidia is the #1 stock in the market for a reason, and everyone wants it. And yep, it's high valuation, but guess what? The funds want it, and they want some Christmas bonuses. HSI, not too bad, and still early stages of potential turn here. I still think it's a game of cat and mouse between China and, of course, the market. The market wants stim. China's saying that we're bringing stim. I think it's going to be after the US election. That could create this type of thing. So you got to be aware of that. Day traders are going to be around here saying, you know what, I'm going to take a gamble and I'm going to try to buy it with stops below the low, because it did feel like, let's say, the gap. It's okay. It's not the greatest trade I've ever seen in my life, but I can understand the concept behind it. Aussie 200, a little bit of weakness here. Still very bullish on the Aussie market. Obviously, it's following pretty much what's going on in China and the US. So with the US starting to show signs of a little bit of weakness, some dark pool transactions at the highs, those types of things, the Aussie 200 may come back down to 8,000, the most traded zone. And that would be the correlation you would expect with something like a 5,700 maybe on the S&P. If we go to the Dow, you'll notice that the Dow Jones again showing signs of significant strength, But again, it's kind of far away from the 20 moving average here on the weekly. And this is what the Dow does. It loves the 20 weekly. You can see how much it's loved it during great runs. So maybe it's time for a little bit of a pullback. We'll have to see. I'm just looking at it from the dark pool transaction standpoint. The Russell. Now, the Russell did have a good closure, in my opinion, on the weekly. And that points towards whatever this sell is here, even if it wipes these lows, I think in general, we're starting to push now the idea of 24.30. And we like 24.30, and I do think that the Russell will end up there maybe by the end of the year. And ultimately, that's a decent percentage. If you think about it, that's actually pushing about 9% up. So not bad from the Russell, and probably driven by deregulation. Of course, if Trump wins the election, it might go harder in KRE. So that's going to be an interesting one. But we'll see what happens because, of course, we don't bet on the elections, guys. Instead, we interpret with patience, data, and really approaching it from an objective approach. It's very important. If we have our emotions involved, we get stuffed, and no one wants to get stuffed because that sucks. Nasdaq, well, this is an interesting chart. A lot of you guys will say, well, Tom, this is super bullish. Yeah, I've said this in the live stream. I'm actually bull and bear on the Nasdaq, and you might say, how can you be both? Well, I can be both because I've actually seen the same two different setups, one for the short end and one for the long end. And I've got shorts that are kind of around here, and I've got longs that are around here. And you might say, how can you have those? It's because often you'll end up getting a break even on one, and a large move you'd have to think is starting to come. This is a bad sign for, of course, the Nasdaq. This last candle that just came through on the futures is a good sign. It could push higher. I wouldn't put it past it. Nvidia are obviously doing some good stuff. But yeah, let's see on the Nasdaq, hey? Let's find out what's going on there. Now, a lot of people messaging me about crypto. They're already worried. It drops 2% and everyone's freaked out. I wouldn't really be too freaked out about 2%. Remember, we hit 68.5. We slightly went above it. And ultimately, what's going on? Well, we're seeing the market pull back a bit. Well, it has to. It has to eliminate many traders and scare them off. Now, I noticed that Solana is doing a lot better than Ethereum. And you can see here the Sol versus ETH chart. It's doing really nicely. So Sol is clearly the new ETH in terms of the way it moves. I still think Ethereum's good, but Solana is the real deal, you would have to think in terms of overall. Let's move over to Bitcoin, 68.5, a little bit of a pullback. Still well within consolidation ranges. This is where you see the first buyers coming in. I'm not discounting the idea that 62.8 could actually be reached and we'll still be long. So yeah, it's okay. Nothing wrong at this stage, guys. And generally the trend has just made a significant structural change. Has it made a high above 70? No, but it certainly has made a weekly above that downward trend line. And I think that's key. And I think that means that along with flows, things are starting to improve. If you enjoyed today's video, guys, please remember to subscribe and smash that like button. Remember, PMI is the main news this week, which is on Thursday. And that's the big one there for the US. So, of course, that's happening at 9:45 New York time. And if you enjoyed today's content, then make sure to, of course, subscribe. Follow us along on some of the other socials, including X, if you're interested in seeing some of the charts we focused on today. And we are running a sale at the moment as well, specifically Day Trading Masterclass and Advanced Class. If you want to learn about cycles, you want to learn about data, TA, and bringing it all together, macro stuff as well, then do the Advanced Class. It'll probably change your life. It has some amazing stuff on it. It took me a long time to come up with a lot of these great concepts. And of course, Day Trading Masterclass, a lot of the replication we use on the show, some of the best setups, that's where they come from. Okay, have a great day, and we'll see you in the next one. Bye for now.